let's go ahead. I'm really super excited to get into what we are going to be discussing with our guest today, Dave. So, Dave Landry has his own company. He can be reached at davelandry.com. He's been an active trader since the early 1990s. He's a speaker at many major trading conferences, both nationally and internationally. He is the author of 3 books on swing trading, and I understand they've been translated into many different languages. So, Dave, if you want to go ahead and uh, share with us some of your work, and excited to have you with us today.
Oh, I'm happy to be here. Thank you so much for having me today, Mary Ellen. I appreciate it.
Oh, of course.
Yeah, as Mary Ellen said, I'm slotted as a swing trader, but I will stick with positions longer term. And I think the money management is very crucial in that. I think you can only predict so far out when it comes to markets, but you could follow trends forever. And when Mary Ellen asked me to come on, markets have been a little choppy lately, so I haven't seen a whole lot of setups. So what I like to do is provide something that you could use both now and in the future. And about the only thing that's really working right now has been the IPOs. The IPO market has been really hot for a long time. So I just took a much bigger presentation. I just whittled it down to just a few charts in here I want to share with you and just a couple little thoughts. And if you could take this away, I think it'll keep you out of a lot of trouble in the IPO market and prevent you from getting caught up in some of the euphoria and the hype. And then 2, it's actually a great little strategy to trade. So let me just show you this real quick. When it comes to IPOs, one of the interesting things is usually the first week of trading, those first 5 days, a significant high or low is set. So if you go back in and look at something like Snapchat, you can see the high was set on day 2. So it came public day 1, day 2, the high was set, and we haven't seen those highs since. So what I began to think about was right before Snapchat came public is could I come up with a little system? And that's where a lot of my research comes from. Like, how do I explain what's going on in the market? How do I come up with something to maybe keep you out of trouble? And I got to thinking about it. It's like, well, my number one rule for IPOs is I won't trade them until the earliest is day 5, meaning they've been up for 1 week. The close of day 5 would be the earliest I ever get into a position. So what could I put out there? And I decided that a 5-day moving average would work well because you wouldn't get that average until at least a week of trading. And I did a presentation a while back where I showed how many IPOs just come public and crash. And I was actually trying to show how great IPOs are. And by the end of the presentation, somebody was asking me, it's like, geez, you're not making a very good case. Well, the point I'm trying to make is that a lot of times they come public and then they just flat out die. So when Snapchat was coming public, I just thought this was the stupidest stock in stupid town. Now, I have a saying, don't confuse the issue with facts. And as a technician, if it's going up, I want to be figuring out a way to buy it. If it's going down, I want to either get out of it or just simply avoid it. And in some cases, I will short. So again, if they don't go up, don't buy them. It's kind of like the old Will Rogers saying. And if you zoom in a little bit on Snapchat, you could see that, again, that high was set on day 2. And then by requiring a 5-day moving average for the pattern, you won't have that moving average until day 5 at the earliest. So that in and of itself will keep you out of bad trades. And I'll give you the actual setup here in just 1 second. So this is just a 5-day simple moving average, which you can easily plot in stockcharts.com. Now, after I did the article on Blue Apron on my website, I noticed that there was another hot IPO coming out, and that was, after I did the article on Snapchat, I noticed there was another hot IPO coming out, and that was Blue Apron. And to my surprise, this thing just absolutely is, I didn't realize how low it was trading, but the high for this one was set on day 1. So that was kind of like a deja vu all over again. And then in more recent times, we had Lyft that came public. And then so far, Uber has failed too, and we'll get to that one in just 1 second. But again, day 1, you can see the significant high was made. Usually within the first week, again, you get that significant high or low. And in many cases, the day 1 high is crucial. So again, deja vu all over again would be Lyft. You can see day 1 that high was made. And since then, we haven't taken out that high. And it's beginning to bottom out and look a little better now. But based on this one particular setup, you would have avoided this stock and would continue to avoid this stock. So let me give you the rules real quick, and then I'd be happy to share these slides with you if you like, or I'm sure this is being recorded, so you'll be able to go and watch Mary Ellen's show if you need these rules again. But they're very simple. In my job, I actually trademarked the phrase trading simplified. My goal is to make trading as simple as possible. I've gone on a grail hunt like everyone's gone through and used 1,000 different indicators and reached that point of analysis paralysis. And at some point, I just peeled them all off and went back to that blank chart again. And I think that's when the true enlightenment comes with the newbies. They go through this big grail hunt. And I could tell you not to go through it, but it just seems like everybody has to go through it. Anyway, long story endless, to come back to this setup, it's like, what's the simplest thing that I could explain or simplest setup I could come up with that would A, keep you out of the IPO for the first week, and then B, get you in if it's a hot IPO, and of course, keep you out of trouble if it's not. And there's only two rules. So the rule number one is the low must be above the 5-day moving average. And that's what I call Landry light. There's like a gap between the low and the moving average. And I'll show you a few examples here and that'll make a lot of sense. And then the stock must close at a new high. Now that's a closing high, not an all-time high, but a closing high. And the only caveat there is, as you saw in those few slides a minute ago, is that a lot of times that high is set on day one. So if day one does set the high for the week, my only other rule would be that close must also be above the day one high. Now, just real quick, and then the reason I use the sardines is the old story of the sardines. It's not enough time to get into that today, but if you Google it, you'll know that there's a famous story about trading sardines, and that sardines are made for trading and not eating. And that's sort of what happens over and over in IPOs. They just take off very, very nicely, but then they begin to die out. So money management is very crucial in this, and I'll touch upon that in just one second. But this is one of the more common patterns in IPOs. If they don't just flat out die, like a Blue Apron and a Lyft and things like that, sometimes they'll take off and they'll be wonderful trading vehicles, but then they'll come right back in. So trading is a key word in that sentence. So let me show you sort of a mediocre setup in this, and this is why money management is crucial. Again, sometimes they fly like Pinterest did recently, and then they die. So here's a trade I took based on this pattern. You can see that the low of the stock was greater than the 5-day moving average. We closed at a brand new high, and within a couple of days, it really took off. Unfortunately, it came right back in. But the good news is, if you're willing to take partial profits, and what I do for that swing trade is I take off half, and then I trail a stop on the remainder, and I let that stop slowly widen out over time to make that transition from the swing trader to the longer term trader. But a lot of times all you get is a swing trade, and that's okay. That's what I call the better than a poke in the eye trade. And then you were stopped out on the remainder. So just a couple of more slides here to give you an idea. I always like to throw out a live trade or two. So in this particular case, here's a trade that I'm actually long. And if you look to the left of this chart, you'll see day 1, day 2, day 3, day 4, day 5. You can see it close at a new closing high. So we're looking for a close above that closing high. And we're also looking for what I call Landry light, which means the low is above the moving average. And you actually buy it on the close. And sometimes it's a little hard to take these trades because you're going in right on that close. And it does take a little bit of a leap of faith, but they can work out really nicely. And again, by requiring that strength and requiring it to close at a new closing high, everyone who has bought the stock prior to you is happy, and you also avoid, again, a lot of stinkers in the process. Now, obviously, the mother of all examples with this would be TLRY. And you can see on day 2, the high was set, but because the high was not set on day 1, the high close we're looking for was actually set on day 1. And then you can see right there, as soon as you close above that and you have Landry light, that would be your actual buy. Now, this is kind of taken to the extreme, obviously, but this is what the setup would look like. And by the way, this is the closest to a breakout pattern that I'll actually trade. I don't trade breakouts in established stocks because breakouts could be quite noisy and there's just an absolute abysmal failure rate. So again, you would buy in the close in this, and this is what it looks like afterwards. The buy was back here, and then we all know what happened afterwards on that one. Turn it to the mother ball. Great examples. This was a weed stock back when the weed stocks were hot. So I guess the question is, where would Uber be based in this pattern? Now, I actually use Uber as another poster child for a stock that failed, but it's actually beginning to come back in here. So your entry would be above 45 on a close, provided, of course, the low was also above the moving average. Now, usually with a big, thick, well-hyped stock like this, I'll actually wait for them to create a secondary setup, usually something like a pullback. But if you were trading this setup in and of itself, your entry would be above 45, provided, of course, again, that low is above the moving average. And you might want to give it just a little bit of wiggle room, maybe like 45, 50, just so you don't get triggered in on potential noise alone. And that's it. I just want to show you a quick little thing about what's working now. Mary Ellen, wherever else you want to take this is fine. Obviously,
Yeah, that was fantastic. I was going to ask a couple of more questions. Just taking a look at your charts. So it looks as if you use the daily chart.
Yes, that is correct.
And a 5-day simple moving average.
Right. For this particular pattern, I use a 5-day simple moving average. For most of my charts, I use a blank chart. And then as we discussed last week, occasionally I will use the bow tie moving averages, which is a 10 simple, a 20 exponential, a 30 exponential. But what I'm looking for with those is I'm looking for a major transition to occur in, let's say, like the overall market, or maybe some kind of stocks that are down, bottoming out after a long time. And in more recent times, possibly some stocks that are rolling over, like the semiconductors. But for the most part, I use a blank chart, and then I just use, for this one particular pattern, a 5-day simple moving average, and that's it.
And can we take a look? Would you mind looking at BYND, that
Sure.
Beyond Meat? And then, do you ever do anything with intraday charts with some of these IPOs, or do you find that the daily chart serves you quite well?
Well, you have to be careful if you're making too many observations and you're looking at a minute little or minute chart or whatever. The problem is you need to be as close to the market as you need to be, but no closer. And I think you can get into a lot of trouble with intraday charts. Now, with that said, two things. One, I do believe that patterns are fractal, meaning that what occurs in one time frame also occurs in others. And if you watch for, let's say, the overall market, if the S&P 500 makes new highs like it did a while back, and then you see an hourly bow tie to the downside, that could be the start of something bigger. Every major transition, in other words, top or bottom in the market, will obviously turn on the hourly first. But I think it's dangerous to watch that hourly too much, because you don't want to get caught up in that, unless, of course, you're at one of the fringes. Now, you were asking about Beyond Meat. Well, you can see, and let me see if I can get the annotations to work with the thing. Just give me 1 second. Oh, here we go. Okay, so Beyond Meat, obviously, what's the rule? We have to wait 1 week. 1, 2, and this first day here, you have to set your chart for the actual first day of trading. So this is where I guess it was scheduled to come public. I don't worry about this price here. I'm only concerned about actual trading. Okay, so there's a long story as to whether or not you should do anything back here, and I believe that no, you should always wait for at least 1 week of trading. But in this particular case, you have day 1, day 2, day 3, day 4, day 5. So the highest close, you see, we're above the day 1 high. So here's a day 1 high here. Let's see if I can draw it in. There's a day 1 high, and then this would be your highest close. So this becomes your entry, and then you need a low greater than the moving average, which you have here, and then you have a new closing high, which would be here. So your buy would actually be on this particular day here. And obviously this one's turned into kind of a wild and crazy one, but that would be based on this little simple system, because two rules are: 1, 5-day closing high, provided, of course, that closing high is also above the day 1 high. That's it. And then the low is greater than the moving average.
Wonderful. And then if it dips below that 5-day, are you concerned if we take this trade out further beyond that what you've marked up there?
Well, when it comes to you every trade, you have to be willing to admit that you're going wrong going in. And that's where a lot of the trading psychology comes in. And the good thing is, if you're using proper money management, it's going to help you with that trading psychology. So if you have a stop in place and you have to just get out of the way if you're wrong. Now, the stop has to be set far enough away from the market to withstand the normal noise of the market. And this has been a very volatile stock, even going back to when it first came out. So this would require a tremendously wide stop. Now, that's a little scary for some people to trade these volatile stocks, but what you do is you adjust your share size down accordingly. And I like to risk 2% max on a trading account on each particular position. So it's not like I'm going to buy 2%, or let's say you got a $100,000 account. I'm not going to go out and buy $2,000 worth of stock. I'm going to buy an amount to where if I get stopped out, I only lose $2,000 boring overnight gaps. Now, that might be 200 shares in a higher price volatile stock, and that might be 2,000 or even more in a lower price stock that's maybe not quite as volatile. And it's a little scary trading the more volatile stocks, but actually I did a spreadsheet a while back showing that with a less volatile stock that's higher priced, you would actually have to put more shares on based on the way the money management works. In other words, to capture that move in volatility in the stock. So in some cases, because you're putting up less money with fewer shares, trading volatile stocks is actually a little bit less risky. And I'm a big fan of trading a more volatile stock. And one thing that you and I were talking about last week is inefficiencies in markets. So I'm looking for something like these hot IPOs that are going to be very inefficient. In other words, they don't trade at a certain level and everybody agrees that they should trade at that level. Something like this, which doubles or triples over a few weeks, is obviously very inefficient. So I'm looking to trade those more inefficient stocks, which tend to be more volatile, and I'm adjusting the share size down accordingly. So, and I know you should never say hope, but hopefully you only lose a maximum of 2% on a position. And as far as the money management, I'm actually taking profits, partial profits, half at a 1% gain. Okay, so if I'm risking $2,000, I'm actually taking profits at $1,000, and the system developers would say, well, that's got a negative excursion, I think is the word they use, but a negative expectancy, sorry. But the reality is, if you can capture that big, we're going for that TLRY type of move. You capture one or two of those a year, and you've made your year. So that's where the real money is in that second loaf, making that transition to the longer term trend follower.
Very interesting. And you're still with your Avantor, AVTR?
AVTR, yes.
Yeah, that's a great looking chart.
Thank you.
So fantastic. And so people, if they go to your website, they can access some of your other articles and your work and other ways that you work with individuals, or?
Yeah, absolutely. And right now on my website, davelandry.com, I have a little drop down when you go to the website, and you could actually download all three of my books for free. And that's going to give you a feel for my approach to the markets from a technical analysis standpoint or a methodology standpoint, from a trading psychology, which is vitally important.
Fantastic. Oh my gosh, I'm so sorry. We have to leave it at that.
Oh, that's fine.
But that's super. So look forward to having you back. It's been great.
Thank you, Mary Ellen.
Thanks, Dave.